All right, today we're diving into a fascinating face-off in India's booming healthcare sector. You've got a super fast-growing company on one side and a really profitable, established player on the other. It's that classic story, growth versus stability. We're going to dig into the numbers and see which strategy is coming out on top. Let's get right into it.
First things first, let's set the stage with this massive number, over 90,000 crore rupees. That's the Indian government's latest healthcare budget. A flood of investment like this is creating huge opportunities, and it's the perfect backdrop for the two companies we're looking at today. And this isn't just about spending more money, it's about spending it smarter. The entire industry is shifting its focus toward better patient outcomes and just being more efficient. This huge transformation is basically opening the door for ambitious hospital chains to really grow, and that's exactly where our story begins. So, let's meet our two contenders. In this rapidly changing landscape, we have two smaller hospital chains that, honestly, perfectly illustrate two very, very different ways to build a healthcare empire. So, on one side, you've got Yatharth hospitals right in the middle of the Delhi NCR region. Their strategy is all about speed. It's what's called brownfield expansion, where they just acquire existing facilities and quickly upgrade them. Then on the other side, we have Kovai Medical Center. They're a well-established player in southern India with a more diverse model that even includes a medical college. It really is the classic disruptor versus the incumbent.
So, the big question is, how do these completely different strategies actually perform? Let's put them head-to-head and look at the hard data, starting with their day-to-day operations.
All right, round one, operations. Let's start with the real fundamentals. We're asking two simple questions here. Just how big are they, and how good are they at actually using what they have?
Okay, what's so interesting here is that at first glance, they look almost identical. In terms of sheer size, their total bed capacity is nearly the same. Both are right around that 2,200 to 2,300 bed mark.
And that similarity just keeps going. Their occupancy rates, which is basically how good they are at filling those beds, are also neck and neck. Both are hovering around 60 to 61%. So far, it kind of seems like a dead heat, right?
But this is where the story gets really interesting. Just look at the revenue each one generates per bed. Yatharth is earning significantly more. So why? Well, their laser focus on super specialty services, think advanced cardiology or neurology, in a major metro area, lets them charge premium prices for really complex procedures.
So we know Yatharth makes more money for every bed. But how does that actually impact their overall financial health? Let's move on to the numbers that really matter to investors: growth and profitability.
And right away, Yatharth's aggressive expansion strategy is just crystal clear. Its revenue grew by a whopping 28% year-on-year, mostly because they were adding new beds. That's more than double Kovai's respectable but much steadier growth of about 13.7%.
And that impressive growth on the top line? It flows right down to the bottom line. Yatharth's net profit growth is also way ahead in this period, clocking in at 33% compared to Kovai's 16%. But, and this is a big but, growth is only half the story. Here's the counterpoint, and it's a major one: profitability. Kovai is much better at converting revenue into actual profit. They maintain a really strong EBITDA margin. That's a key measure of profitability of around 29%. Yatharth, on the other hand, is feeling the financial drag from all that rapid expansion, and that means lower margins for now. So all this brings us to our final round, valuation. You've got these two different profiles, high growth versus high profitability. What price is the market actually willing to pay for each of these companies?
Well, the market has definitely placed a premium on Yatharth. It trades at what's called a price-to-earnings ratio of around 40. Now, that high number signals that investors are expecting its rapid growth to continue well into the future.
Okay, but wait. That's a term we hear all the time in finance. But what does it really mean when we say a company has a high PE ratio?
To put it simply, the PE ratio is the price you pay for 1 rupee of a company's earnings. A higher number, like Yatharth's 40, doesn't automatically mean it's expensive. It often means the market is betting heavily on its future growth potential to justify that price today.
So, after looking at their operations, their financials, and their valuation, what's the final verdict here? What do all these numbers really tell us about the two different paths these companies are on?
When you boil it all down, we're looking at two fundamentally different philosophies. Yatharth is the sprinter. They're playing the growth game, expanding like crazy to capture market share, even if it hurts short-term profits. Kovai, on the other hand, is the marathon runner.
prioritizing stable, high-margin operations and steady, sustainable growth.
So, the key thing you should take away from all this is that there's more than one way to succeed. Yatharth represents that high-growth, expansion-first story. Kovai represents the stable, profitability-focused veteran. And the market, well, with its higher valuation for Yatharth, is clearly betting on that future growth potential.
And that leaves us with a final big question to think about. In a sector being totally transformed by massive investment, which strategy actually wins in the long run? Is it the aggressive expander burning cash for growth, or the profitable stalwart building brick by steady brick? The answer is really going to shape the future of India's healthcare landscape.